Welcome to ETF 360. I'm Tom Lydon of ETF Trends, and I'm pleased to be joined by our Director of Research, Dave Nadig. And we have a special guest, Amy Zhang, who's Executive Vice President and Portfolio Manager at Alger. Hey, Amy, coming out of the financial crisis, if you bought the S&P 500 and just held it, you would have done really well. But lately, smaller stocks are kind of coming into their own. Have we started to see the pendulum swinging?
Yeah, of course, because I think at Alger we're stock pickers, so it's really important to be in an inefficient market. Mid-cap market is very inefficient, so it's a really fertile ground for stock pickers like us at Alger for active management.
So Amy, you run the Alger Midcap 40, ticker FRTY, and I did a quick check before we jumped on. That's a 90% active share versus the equivalent sort of Russell Midcap Growth Index. What are you doing that's so active? What value are you bringing as an active manager?
Well, nowadays you can definitely buy cheap beta. So this alpha generating strategy is really high conviction, best ideas. And it's very barbell in the sense at Alger, we wanted to have our growth cake and eat it too. So we will invest in high quality growth companies, but also have exposure to the depressed end markets, so that we can participate in the cyclical recovery as well.
Amy, do mid-cap reopening stocks really have more room to run? They've had a pretty good run lately. And can you give us maybe an example of a company you're really excited about?
Yes, the key is we want to invest in company that high quality also have secular trends in addition to reopening. So we don't want to invest in low quality, junky. A lot of reopening companies are very junky, and their growth is not sustainable. So, for example, one of the companies we invest in is U.S. Foods. That's the second largest food distributor in the US, and it's also the most innovative and tech savvy. So, clearly there's a very huge secular trend of dining outside home, before the pandemic. So before COVID, it's about 50-50 in terms of eating, when you think about people eating at home and outside of home. And now the percentage of people eating outside of home is only 35%. So clearly that's a huge, opportunity to go back to the 50%, but also longer term higher. So that's very important to have that powerful secular trend, the underlying, trend there. But more importantly, currently why U.S. food now is they definitely suffer from the pandemic. And clearly, they serve all restaurants and hospitality sectors and schools, hospitals. And for a restaurant, which is the largest sector, that, clearly there's a significant government support recently, with $29 billion, the Restaurant Revitalization Fund. So for example, that's a very strong tailwind. And in terms of company Pacific, this is a very high quality company that it has the scale and the technology and product offering to really continue to gain market share, to take market share away from the weaker, smaller players, and the industry is consolidating. So, also lastly, on the valuation front, it's a great catch-up play because still trading cheaper than its peers, Cisco and Performance Foods. So we think U.S. Food is really well positioned to capitalize on the cyclical recovery.
So Amy, companies like that, often get overlooked, I think, by many investors. We've seen so much movement in some of the big names at the top of the cap spectrum, the Teslas, the Apples of the world. Is part of the plan investing in mid caps to find companies that are really good acquisition targets?
Yes, or a company that has done very well in M&A. At Alger, when we think about, growth, right? We invest in positive dynamic change. So there's high growth companies, maybe on the left side, but on the right side, it's really about companies going through what we call the renaissance of growth. So, maybe through M&A, but as you mentioned, M&A recently they bought their competitor Wellbuilt, right? So that's a very accretive, transformative acquisition that will add a lot to their both top line, bottom line with significant revenue and cost synergy. And this is more of a compounder, right? The company has done well in the good times and bad times, and very strong cash flow generating capability, very strong financial quality, and we will expect them to be a compounder. So that's what we want our companies to be, compounder in our clients' portfolio for wealth creation.
Well, Amy, I don't know, Dave, I don't know about you. All this talk about food, my stomach's starting to grumble. But I appreciate you coming on, Amy, and we look forward to having you back on ETF 360.